Blenders, that one reported its numbers, and to understand what the outlook is on the company going forward, we now have Mr. Alok Gupta, Managing Director at Allied Blenders and Distilleries. Mr. Gupta, afternoon. Thank you so much for taking your time out and joining us here on ET Now. And you've reported strong growth on the top line on a year-on-year basis, which was driven by strong volume growth of about 17% that you reported, especially in the prestige and above, that is the P&A category. But the big question now is, will this kind of growth sustain going forward? If you can take us through what the outlook is when it comes to volumes, both for the fourth quarter of FY26 and for FY27 as well.
As regards our P&A growth, we believe that we will be on our guidance. We have maintained middle-digit volume growth and double-digit value growth, and that will be driven by P&A. P&A is already accounting for nearly 48% of our volume. We had given a guidance that we should cross 50%, and we believe that in quarter four, we should be meeting that guidance. This is on back of strong growth of brands like Iconic and further distribution footprint both in domestic and international markets.
Right. Hi, this is Ankita also joining in. So the softening of the commodity and the packaging prices, along with some benefits from backward integration, has led to the gross margin improvement by 351 bips on a year-on-year basis. What are your thoughts on commodity prices and its impact on the gross margins going ahead?
I think a capex program is on time. The PET program, the ENA program, and we recently announced a state-of-art bottling unit in the state of UP. All this will be margin-accretive. We will see further expansion in our gross margin by about 300 basis points, and this will all flow into our EBITDA margins. As far as the commodity prices are concerned, I think they will be fairly stable and soft, and our Q4 outlook, we do not expect any significant changes in the commodity prices.
Understood. So that's as far as commodity prices are concerned. But let's also talk about your global expansion plans then. What is the status of that? You plan to increase your presence to about 35 countries by March this year. Is this on track? And which geographies are you particularly focusing on with respect to your global expansion plans?
Absolutely on track. As we speak, by end of quarter three, we are already in 31 countries, and we'll add a few more in quarter four. Our focus is now beyond GCC. We have opened up Africa as a continent significantly in terms of number of countries, including Latin America. And we also are making our presence felt in some more evolved economies. So we are currently opened up, if you go from east to west, from Australia to New Zealand, Malaysia, Singapore, all the way up to Europe and America and Canada. So the distribution footprint is absolutely on track. As our luxury portfolio is getting built out, this distribution footprint will help us get better access to the market and drive further value growth.
Right. Also, any product launches in the pipeline over the next 3 to 4 months?
Well, we've done significant launches on the luxury side. As you know, we have 9 beautiful brands in our portfolio. We did 2 significant launches in the last quarter, which is Rangila, which is a vodka, and A, which is our Irish whiskey. So our portfolio is nearly complete. We will, in quarter one next year, make an entry into the deluxe vodka segment. But for this year, we are pretty much on track on our new product rollout.
Understood. So that's as far as product launches are concerned. But Mr. Gupta, now with India-EU FTA being signed, what kind of benefit will the industry and you in particular enjoy on account of this bilateral agreement?
The India-EU FTA is quite similar to UK, except there's an accelerated drop down in the duties. From our portfolio perspective, we do not expect any major impact, as bulk of the import from EU is largely wines and vodka, liqueurs and brandies. We do not operate in that segment. And even from an India context, that accounts for a very small percentage of total consumption. How it opens up market for marketers like us, I think would be very interesting. For example, we are looking at setting up a distribution hub in Europe, and our ability to then service markets locally for our mainstream and luxury portfolio. I think that will be an interesting development, and we are staying out of the European market.
Right. So the EBITDA margins have been steady in the range of 12 to 14% over the last 2 to 3 quarters. Are you really looking to expand the margins? And if yes, by how much and by when can that happen?
Well, if you look at our guidance for the fourth quarter, we were at about 7.5% in FY24. We are nearly double of where we started our journey about 6 quarters back. We are currently close to 14%. We should see quarter four margins to be again about 14 odd percentage. But the capex program that we put into place, which will sort of fully be on board by quarter four of next financial year, we should see further expansion. Also, FTA, which is likely to be implemented, let's say between quarter one and quarter two next financial year, would also have a 200 basis point impact on our margins. So our guidance is that over the next 2 years, our EBITDA will expand from current levels of about 14% to about 18%.
Understood. And Mr. Gupta, you have generated about 3,000 crores of revenue so far in the first 9 months of FY26. What is your outlook for the full year? Will you be able to cross that 4,000 crore revenue mark for the full year?
Yes, I think we are sticking to that guidance.
All right, so thank you so much for taking the time out and joining us and weighing in on the numbers and the growth guidance ahead. With that, it's time for us to slip into a short break. Don't go anywhere. After the break, we'll get you more managements on the other side. Stay tuned.